Hi, Nancy. All right. Well, thank you everybody for joining today. Today's webinar is hosted by Zoe Financial. I'm Alexandra. I run the marketing team here at Zoe, and we're thrilled to have you. So let's start with a brief disclosure. This presentation is not to be taken as investment advice and should not be relied on for such advice or as a substitute for consultation with professional accounting, tax, legal, or financial advisors. The observations made are independent of Zoe and should not be read as financial recommendations. Thank you again for joining us for today's workshop on tax strategies to grow your wealth. This is going to be a great webinar with many insights on how to reduce your tax liabilities. So I wanted to start by introducing Nancy. She's a Zoe vetted advisor, and she joined Muller Financial Services in 2021 as a financial planner. She originally started her career as an investment analyst and portfolio manager for institutional pension and insurance funds. Nancy wanted to directly impact families and individuals' futures. She earned her Bachelor of Science degree in econ from the Wharton School at the University of Pennsylvania and has held the Chartered Financial Analyst designation since 1993. She earned her Certified Financial Planner designation in 2019. Nancy has supported education through a variety of volunteer positions, including president of the local Winnetka School Board. Nancy, thank you so much for joining us today.
Thank you for having me. I'm happy to be here.
We're thrilled to have you. During this workshop, we will be discussing a number of different aspects related to tax planning opportunities to consider. We're going to talk about retirement savings, gifting and giving, timing of strategies, Q&A. For that Q&A, if you have questions throughout, please be sure to send your question directly via the chat. And thank you to all of you who had already sent your questions prior to today's webinar. We'll be sure to answer them at the end of today's event. So to get started, I wanted to jump off with, a really interesting fact. In 2020, the top 1% earned 22% of the total average gross income, and yet they paid 42% of all federal income taxes. That's almost 50% of the nation's federal taxes coming from the top 1%. What's relevant here is how tax planning can be something you can really be proactive about. So this slide gives even more importance on why high earners such as yourself who have joined on today's call can really maximize your strategies that Nancy will share and cover. So let's get started. The goal of many on the retirement side is to improve their saving strategies. So Nancy, let's talk about, what retirement savings has to do with a tax strategy.
So there are two main ways of saving for retirement that are tax advantage. There's your traditional IRAs, 401ks, and 403bs. And now there are the Roth versions of IRAs and 401ks and 403bs. They have different tax opportunities with them, but both give you advantages as opposed to just putting it in the bank.
Fantastic. That's super helpful. So Nancy, how does one know when to use a traditional IRA or a 401k?
Well, let's talk about the traditional IRA and 401k first. So with a traditional IRA, your contributions are pre-tax dollars. So it's deducted from your taxable income what you contribute. So that lowers your tax bill for the year currently. And there is, for 2022 taxes, you actually, if you haven't already, you can contribute to an IRA up to $6,000. And you have up until tax filing date, April 18th, to do that contribution. For 2020, and if you're over 50, you're allowed to have an additional $1,000 catch-up contribution that you can make for a total of $7,000.
Wow.
For 2023, you can raise that to $6,500 of contributions to your IRA. Now, there are subject to some income limitations, so that's part of consulting with a financial advisor would help you understand if you can, in fact, do that. We also, many people have 401ks or from nonprofit institutions, 403bs, that you can save directly from your paycheck. And you can save up to $20,500 in 2023. And if you're over 50, there's a catch-up provision there as well to raise it to a total of $27,000 you can save in your 401k. Two great tax advantage ways. So you're saving pre-tax, you're reducing this year's taxes. The earnings in those accounts grow tax deferred. And when you withdraw the funds, that's when you pay tax. When you take your required minimum distributions or other distributions in retirement, you'll pay tax on that as income.
That's great to know. And it's nice to know that these assets grow, and are tax deferred as they're growing in the accounts. How about with Roth IRAs or Roth 401ks?
So we're flipping things when we work with a Roth IRA and Roth 401k. So the contribution is after tax. You're not getting any tax benefit now for contributing to your Roth IRA or Roth 401k. What you are getting is the growth of those assets over time grows tax-free. And then when you withdraw in retirement, though you're not taxed then either because you paid the tax originally. So contribute the same amounts as you can in a Roth IRA and a Roth 401k as you can in a traditional IRA and 401k, subject to those income limits as well. But when you were in retirement with the Roth IRA and Roth 401k, you can withdraw those at any time without paying taxes. Or a traditional IRA and 401k, you have to do required minimum distributions. The government makes you withdraw, and you have to pay taxes on it at that time. So your choice is traditional IRA, 401k. You avoid taxes now, but have to pay in retirement when you withdraw it. With the Roth version, you pay taxes today, but you don't have to pay in retirement.
Got it. That makes a lot of sense. And I'm sure for most of you folks joining us and listening, you're probably wondering and scratching your head, how do I know what is best for me? Is it a traditional pre-tax or a Roth after-tax saving? Nancy, in your experience, where do you often recommend clients start?
Well, this is a great place to work with a financial advisor who understands your lifetime tax situation because it's different for each person. Typically, I recommend some sort of mix between the traditional and the Roth accounts, which allows flexibility in retirement for withdrawing and having to pay taxes at different points in time. And over one's lifetime, I will ask clients to lean it one way or the other. When you're at your peak retirement earning years, probably a time where you want to do more of the traditional and IRAs and reduce that tax bill at that point so that you're paying at a later time when you're at a lower marginal tax rate. When you're young, you may want to do it on the Roth version because you are at a lower tax point than you expect to be later in life, but then of course you hit the cash flow issues of a young person, and having to pay taxes on that contribution may not be the right choice for them, and that's why working with a tax advisor and a financial advisor can help you make those decisions and make those changes over your lifetime. That relationship really helps to make those changes.
That is incredibly helpful, Nancy. Thank you. I found this really interesting, and I'd love to understand a little bit more about those Roth conversions and how that pre and post-tax work. What is a good way to understand the strategy? And ultimately, how does one know if it's right for you?
You probably have heard in conversation this Roth conversion and not sure exactly what it is. So you are able to take funds that are in your traditional IRA and roll them over to a Roth IRA. So when you do that, you pay, because the traditional IRA is a pre-tax, you pay tax when you do it, and then it goes into your Roth IRA, and then from there on, it'll grow tax-free. So you won't pay tax, you'll pay tax now when you do that conversion, and then you won't have to pay tax later on when you actually want to withdraw the funds.
Understood. And how does one know, or rather, does this strategy, Nancy, depend on the marginal tax bracket that one falls into?
It does. So in a lot of people, we recommend that point between retirement and when you have to take required minimum distributions, because many people are at their lowest point, a marginal tax rate then, because income isn't coming in regularly. You might be taking out of your bank account at that point. But working with a financial advisor is important here too, because if you do too much, you can bump up your Medicare surcharge and do that without realizing.
Oh, no.
And so understanding the implications of what doing that Roth conversion is not quite as, really having that professional advice would help. You can do it today too. You could do it also today while you're working, but, and say you have room, you're at the 22% tax bracket and you're well below, maybe filling up that space in there up to that point, not pushing over into the next tax bracket, but you have some room to make that choice and help those funds grow, tax-free from that point on.
Incredibly helpful and very insightful, for me personally, I'm sure for tons of folks on this call. So thanks for running over that. Next, we have gifting and giving. So many people like to save for their children, which is, one of the first strategies that we have that we'll be discussing. I think gifting and giving is an incredibly powerful way to not only make a difference for your loved ones, for various charities that are aligned with your values, but ultimately they can make a big difference in your tax bill at the end of the day, right? So Nancy, could you walk us through some of the gifting and giving tax strategies that our audience here can implement today?
So there are several tax advantage ways to make those goals happen for you. They are probably after retirement, the next most frequent goals that I hear are to be giving and supporting your children through education and to give to their favorite causes. So 529 plans in terms of education savings, and then in terms of gifting to charities, you may be able to do a qualified charitable distribution, donate appreciated stock to a charity, or use a donor advised fund as a means to donate to charities. Those are quite a few great ways to implement those gifting and giving tax strategies. And something when you first mentioned this during our practice run, I was frankly surprised by the 529 plans. It hadn't really occurred to me. And so I started doing some research and I found that 15 million 529 accounts exist in the US, and they sum up to about 457 billion. So clearly quite a few Americans are taking advantage of this strategy. Let's go over 529 plans. Nancy, can you tell us more? Sure. So 529 plans are a way to save for education. When you invest funds in a 529 plan for your child or grandchild, they grow in there tax-free if the funds are withdrawn to pay for qualified education expenses. And those are listed out as, tuition, room, board, very delineated expenses. Great way to help pay for college and allow that growth over time work for you. And then recently, at the end of 2022, part of that Secure Act 2.0 the government passed allowed, if your funds worked really well for you and, you ended up with more than you expected. So that's often a worry I hear, that am I putting too much in? So the government passed the Secure Act 2.0, which allows up to $35,000 to be converted to a Roth IRA for those individuals. The catch on that is it has to be open for at least 15 years. So it's often someone who saved and the funds just did really well beyond what they expected for college. So it's great to not have to face that tax penalty of withdrawing. You can put it into a Roth IRA and support your children further.
That's a great tip.
So opening them now will start that clock for being able to have that extra benefit, and also take advantage of the fact that you can use compounding to grow your funds from now to when they're actually heading off to school.
I love that you mentioned this one, Nancy, as well, because most of our audience doesn't know that advisors can really help manage this account. Could you tell us a little bit about what managing this account with an advisor looks like?
So each state has the 529 plan, and 30 states actually give you additional tax benefits for contributing to your 529 plan. So knowing which fund to invest in within those accounts, there are target dates for when they're going to head to college. There are choices within it in terms of individual investments you can choose instead, and so you can work with an advisor to have a recommended portfolio. We don't change those very often, and some of the funds don't allow you to change it that often, so having a good plan and checking on it, because kids age up, and so you want to make sure that fund is there when you get to having to pay that college bill. For children, I know that's important.
Definitely, that's a big one. So now moving on to our giving strategies, the first one we have here are qualified charitable distributions. Can you guide us through the strategy and share a few insights into when someone might want to use a qualified charitable distribution?
So if you're at the point of taking required minimum distributions from your IRA and 401k, if you give directly from that IRA to the charity, it's called a qualified charitable distribution. And you get to deduct that dollar for dollar against your required minimum distribution. So you give to the charity. So say it was $10,000 you have in an RMD and you wanted to give $3,000. If you give it directly, the charity gets all $3,000, and you only have $7,000 of required minimum distribution that you report on your tax return then. If you were to take the required minimum distribution, you have to pay tax on that whole $10,000 and then give to the charity. So this way, it's a win-win for both you and the charity to do it directly.
That's awesome. And for those who are currently taking RMDs, I see here there are some limits. Could you tell us a little bit more about that?
So you can give, they have to be 501c3 registered charities, and you can give up to $100,000 a year to the charity from your required minimum distribution. So it is limited that way, but it does reduce dollar for dollar your required minimum distribution, and it helps you on your taxes.
Yeah, that's awesome. And $100,000 is a huge impact for a variety of charities. So it's great that the IRS has a big limit on those, or a big room. So how about donor advised funds? Moving on to our final our second giving strategy here. Can you tell us more about these?
So a donor advised fund, you donate one into the fund, and then you can donate from there or direct which charities get the monies over time. So especially useful when you have a big income year. Say you've got a big bonus or another reason, particularly you want to make that donation so you can itemize on your taxes and take that deduction. But if you've been working with a charity, you may feel uncomfortable about giving it all at once. You'd rather give it over time. So it's a perfect time to put into the donor advised fund, take that tax deduction and itemize on your taxes for it. And then you're able to donate and direct where those funds go over time through the donor advised fund. Taking those.
That's fantastic. So
a variety of charities.
Yeah, that's amazing. And you're telling me that with a bonus, I can just, basically donate that and not have that bonus affect my taxes. Is that right?
Right. You can itemize, that'll help you itemize on your taxes. And so that charitable gifting. So a lot of, with the larger, standard deduction, we don't always hit that anymore. So when we have an income year like this, it's a great time to give and bunch up your giving in 1 year to be able to itemize.
That's a great one. And that's really good to know for everyone on the line listening in. You can itemize that deduction and ultimately put that bonus to good use. So now on to our final giving strategy, donating appreciated stock. How do these work and how do people benefit from this strategy, Nancy?
So you can donate to your favorite organization by donating the stock directly from your account to the charity. And so the transfers to the charity at that market value. And you take that deduction at the market value for the stock that you donated. If you were to otherwise take that stock and sell it, you'd pay capital gains on that on the sale and then give to the charity. So charities have realized this is a win-win. So many charities have set up the ability to take that stock directly. Contact your charity to be able to do that. And they should be able to help you to avoid that capital gains tax that you have to pay if you sell it and then donate cash to them.
Incredible, Nan. So I want to ensure that I'm understanding this correctly. If I were to sell that stock, the outcome would not be as beneficial as if I were donating that appreciated stock. Is that right?
Exactly. Say you've owned, Apple stock and it's done well for a long time. It's got a lot of capital gains for you. So selling it, you've got a pretty high capital gains tax you're going to have to pay. But if I want to donate it, say, to the Red Cross, I would just give them donate directly that stock right out of my brokerage account to the charity. And that way I don't have to pay that capital gains tax, real savings for you, while you're still helping the charity.
That's awesome. So I think we've come to the big question of the hour, which is how do I know when to plan for these strategies and when should I start implementing them? I know you have some great answers to this question, so let's get into that. Can you tell us a little bit about tax loss harvesting?
Sure. So tax loss harvesting, many people think of doing this towards the end of the year. We're kind of in that, okay, let's clean up the end of the year and harvest some tax losses. So what tax loss harvesting is for if you have an investment that didn't do well and has a loss, you sell it at the loss and it's registered as a capital loss for tax purposes. And you can either offset that from capital gains you've gotten from other investments that have done well, or you could potentially deduct up to $3,000 at that loss off your income taxes, ordinary income. And if it's more than that, you can carry it over to future years. We often think of doing that, kind of at the end of the year, but if you think back to COVID, March 2020, stocks dropped 30%, S&P 500 from its peak. If you have a financial advisor who's watching your accounts every day for you, then they realize to harvest some of those tax losses then, because soon after those stocks rose back up. So if you did it at the end of 2020, you didn't get the same amount of tax loss harvesting you would have if it had been done throughout the year. So having an advisor walking side by side and paying attention to the portfolio movements can really help you take advantage of taking these tax losses and banking them for when you have gains in your portfolio.
Yeah, this is a huge one. Nancy, would you say this is applicable to a lot of people right now, considering the market that we're currently in?
Absolutely. We've watched a few days here where the market hasn't done as well. Maybe some of those investments are, underwater. So selling them, and then you would sell them and then buy a similar, slightly different investment. So you're still in the market looking for the gains, but you've booked that tax loss today.
Yeah, this is a huge one. This definitely, now that you've walked us through it, Nancy, seems like one of those strategies that if you aren't maximizing and you don't have someone kind of on your side of the table showing you how to do this and when to do this, you're missing out on some important opportunities.
Absolutely. Keeping on top of that, everybody's busy day to day to be watching, this detail. That's what a financial advisor does for you.
Definitely.
Not something, you're worrying about other things, and maybe not this to the extent, and really it's some great opportunities to catch.
Yeah, and if you're anything like me, the idea of going in and looking at those losses is a little bit painful personally. I'm like, oh, I don't want to see it. I don't want to look at those losses. And so having somebody who can help walk me through that and ultimately, not have to think about it is a great one.
Yes. In our practice, we try to remove the emotion out of the investing so that, we're really, following a plan for the long term. And that's a tough time to do it when you're dealing with losses.
Definitely. So going into our last slide here, can you speak to what sooner rather than later means, and maybe why one shouldn't wait until the year end or till April to really get started on your tax planning?
Sure. So there's no reason to wait to year end to fund your IRA. You can do that earlier in the year so the growth is in that IRA account working for you towards your retirement. You don't have to wait to the end of the year to do that. You also, while it's not all clients, there are some clients that have, estates that are large and need to move things out of their estate for estate planning so they avoid the estate tax. And certain states have lower estate taxes as well. So it's even more of an issue in certain places. So you can gift assets earlier in the year to, children, to charities. An individual gift of up to $17,000 per year per recipient without triggering gift taxes is possible for an individual. So doing that earlier so the growth happens outside of your estate is important to those clients.
Incredibly helpful, Nancy. Thank you. And it's good to know that one just shouldn't wait until the end of the year to make these really crucial changes and ensure that you're locking in all of those tax strategies, and really making sure that you're okay. So this is actually my favorite section of every single one of our webinars. Nancy, I'd love to hear why you became a financial advisor. It's clear you're incredibly passionate about what you do and incredibly insightful as well. So I'd love to hear, what led you down this path. And this is a very cute picture.
Thank you. I really like helping people make intentional choices with both their money and their time. No decision is right for every person, but making those choices intentionally. We go along, well, I've always done it that way, and you don't think about it, but, working with people and stopping, getting them to focus on their goals and really, helping them reach those goals, it's just great.
That's an excellent one. I know for a fact having an advisor has personally really helped me make light and bring, a really long-term plan. I tend to be very short-term personally. And so I'm thinking about the next 5 years or the next 10 years. And this advisor has helped me get into, what my future looks like when I'm 60, when I'm 70, and what I want my future to look like. The idea of being really intentional with one's future is incredibly powerful, especially when it comes to something as year to year as tax strategies and tax planning.
Absolutely. And with a financial advisor, as opposed to an accountant is recording what you did over the year. we're looking over the long term of your situation to find tax strategies that will work over your lifetime, and not necessarily something an accountant is focusing on typically.
Sure, that is a fantastic point. And I'm glad that you mentioned it because that's actually one of the questions that we've received ahead. So if anybody on the line wants to connect with the top advisor like Nancy, please feel free to give us a call. Our client concierge team is standing by. You can also give us a shout directly via email, concierge@zoefin.com. You can text us, you can go on our site. We are available for you if you're interested in diving into these tax strategies and other financial planning strategies a little bit more in depth. With that in awesome. Thank you, Nancy. Well, with that, I think we can call it a day. It has been so great having you on. So thank you so much for getting us, so educated on this topic. Please, anybody who's joined, please share with your friends and family. We'd love to share all of Nancy's amazing insights with everyone today. And Nancy, again, thank you so much for your time and for all of your tips. I know they were invaluable for me and certainly for lots of folks on the line.
Thanks so much. I appreciate having the opportunity.
Thanks, Nancy. Have a good one. And thank you everyone for joining. Have a great rest of your day and good luck this tax season.